In investment markets, the London story, again, I think is very familiar to most people here. We have seen, since the middle of 2009, a pickup in investment volumes and activity in the London market. It has not taken us back to those exceptional levels of 06, 07, because we've not got the same amount of debt or anything like it coming into the market. In fact, very little debt. This is predominantly an equity-driven uptick in values, and most significantly, predominantly driven, as you can see there, by overseas investors, overseas purchasers in the central London market. So since mid-2009, they've accounted for around 70% by value, much higher, as you can see, than in previous periods. So London proving in this period very, very attractive to international investors, and that in turn associated with an extremely rapid repricing of this market through this latest cycle. It repriced negatively very rapidly from 2007, yields expanding very, very sharply, but equally then repricing very rapidly in a positive direction once the market turned. And in that respect, again, this latest cyclical picture has been different from previous cyclical pictures, where when yields reached elevated levels, they tended to stay there for a while the market was becalmed. This time around, much more an inverted V shape. Now, again, if we turn to New York and look at the Manhattan market, and these indicators a somewhat different picture, partly similar, but in certain key respects very different. Again, we have a boom reaching its peak in 2007, and then investment volumes collapse. What really intrigues me on this chart is the extent to which they collapsed to the point of non-existence in 2009. You look there, $1.5 billion of investment transactions in the whole of the Manhattan market in 2009. I mean, the market effectively seized up and stopped operating. This is a market with no liquidity. Worth asking why and how that happened. Is it related to the very, very high degree of securitization in this market that basically these vehicles extremely difficult to untangle. Those who wanted to get out couldn't get out. Those who might have wanted to come in couldn't access. We've seen some improvement in volumes in the past year and some improvement in values up to $8 billion, but as noted earlier, that's still well behind London. Worth noting here, however, that only 12% of those purchases in 2010 involved foreign buyers. There may have been some other overseas money coming in via other conduits that doesn't appear directly as an overseas buyer, but only 12%. And maybe out of that 8 billion, a bit over $1 billion could be attributed to distressed sales. Quite a different pattern. In terms of the repricing, well, we did have very sharp repricing using a cap rate indicator here. You had strong cap rate compression, decompression through to the middle of 2009, and then a period of sharp recompression, although that seems to have run its course over the second half of last year, with those yields or cap rates stabilizing, it would appear, at a relatively high level, certainly a high level relative to where they got to at the top of the market. In Hong Kong, a different pattern again, although with some similarities. Here you see investment activity did fall away and values fell as yields expanded through to the first quarter of 2009, the real low point, a common low point around the globe, obviously, immediately after Lehman's had collapsed. And then, however, we see there a very strong recovery in investment volumes coming back, and very strong yield compression, actually taking yields down by the end of last year to the lowest they had been for some very considerable time. In fact, lower than they had been, you can see there, before the crunch struck in 2007. So this is a market, in investment terms, in brief, going like a train. One of the things that may be helping that is that, in contrast to London and New York, there is debt available in Hong Kong to finance property investment. It's just showing the percentage year on year as measured by the Monetary Authority availability of loans for property, and you'd see, okay, that tightened sharply in 2009, but it certainly has bounced by 20% in the past year. Not a picture we're seeing in the UK or the US. And as a consequence of that, you've got an interesting picture in Hong Kong. If we look at rents and capital values, in fact, for much of the period up to 2008, those were moving more or less quite closely in sync. Capital values then started to accelerate at the height of the market, then fell, but you can see there they have rebounded very, very strongly, much more strongly even than the strong growth in rents, and are now, in fact, higher, their office capital values, than they were before the crunch. Is this market, in fact, now beginning to display some symptoms, interestingly, of what we were seeing in UK and US markets in 2007? A somewhat different picture in Tokyo. There has been some pickup this year in investment activity, over the past year, but that seems to have faded somewhat in the second half. We're only looking here at transactions over $50 billion, which does leave out quite a large part of the market, but just looking at the larger transactions. But the other point, I think, interesting point to make about this market, as you can see, again, is the virtual absence of foreign investors. It's all domestically driven. This is not, in that sense, an international real estate market in the sense that London is or anything like it. In terms of the trends there, we've seen falls in capital values. Cap rates, yields appear to have been pretty flat, at best, therefore stabilizing. And so consequently, the picture for rental and capital value trends in Tokyo stands in marked contrast to its Asian neighbor in Hong Kong. You can see there where at best you would say they were presently stabilizing after pretty steep declines. So clearly a market in a very different state at present than the others.